Well, there was a Tête-à-Tête in Washington yesterday, and we're going to have our very own here in Toronto. Real estate numbers came out in April. They did not look as stellar as anybody was hoping, but probably what we had all predicted. We're going to dive into those as well as the direction of what's happening with interest rates. Are they going down? Are they going up? Maybe a little bit of both, but we're going to dive into the numbers. I'm Sean Humphreys, joined as always by my co-host Von Zawadzki, and this is Mortgage People. Von, how are you, buddy?
I am good, sir. The weather is heating up, but I'm not so certain about the real estate market.
Yeah, usually at this time of the year, the weather gets nice. We get out our golf clubs and feel guilty because we're so busy with the real estate market, but that has not happened. Numbers came out this week, and for April, number of sales year to date is down 20%. We were certainly expecting to have a bit of a stronger real estate market going into the spring. Interest rates, the Bank of Canada rates have come down, and so the predictions were we're going to have a pretty good spring market. Now that has not happened, at least not this far, but it seems like that has a lot to do with uncertainty. What's your overall take on these numbers, Vaughn?
Yeah, there is, I hate to drag like a cultural phenomenon into anything. I'd rather keep it to the numbers, but I mean, we are human beings and we do move, in a group together. And I think that's what we're seeing. A little bit of uncertainty over time can create a lot of uncertainty. I have a prediction of, or an estimation of where it's coming from and in the employment area, and we'll take a look at that after. But in general, it doesn't necessarily have to be one factor. But as things slow down, we've got this reverse FOMO happening at the moment.
Yeah. Condo sales in particular are down 7% from last year. The average sale price in 2024 was 728. We're down to 678,000. This is for Toronto or for the GTA in total. So that has a lot of different types of condos in it. That's not just downtown, but that's the 905 where we're seeing some pretty big price decreases as well. But the kind of overarching number is the number of sales. Let me just switch to a different view here. Actually, you won't be able to see it, but number of condo sales so far this year is down to 1,430, which is down 30%. That's 29%. That's a big number.
Is this all resale that we're looking at, or is this a new development as well?
Yeah, new development and resale. Anything that's hitting the MLS system.
Right. Yeah, and I mean we've talked about it, and I think we're going to talk about it more today, is the specific types of condos. It's good when we look at this information to pull out specific markets. When we look at detached properties, they're holding value just fine, and they're not really increasing in value. But it's really the condo market that's really impacting the numbers if you look at GTA or probably Greater Vancouver as well, because a lot of those purpose-built rental units, they're just not moving right now. The investors, trying to pull out, and nobody wants in at this particular moment.
Yeah, top line here being the total number of sales for 2025. So I know you can't see it on your screen, but 25 through to 2020. This is for the whole Toronto Real Estate Board. So this is April 2025, the total number of sales, this is all property types, is at 5,601. Last 2024, which wasn't a banner year, that was 7,302. And you can see in 2021, which was a huge outlier, was 13,613. We're a lot closer to the 2020 pandemic number than we are to the 2021 real estate market's on fire number.
What a difference when you look at that altogether. How we went from people were terrified to leave their house, so there was no action, and then once it started warming up, it really caught fire, and then looks like 3 years of pretty close numbers, and now we're feeling the squeeze on the other side.
Feeling the heat now, and then months of inventory. I don't know if maybe our listeners aren't sure what this number is, but months of inventory means the total number of active lists, how many months it would take to eat up the total number of active listings based on this month's sales. So basically 27,386 divided by 5,601 is going to give you a 4.89 months of inventory. So almost 5 months. And so if you look back, that's even worse than where it was at the start of the pandemic in 2020. And that's, 10,000 active listings versus 3,000 sales is nowhere near the 27,000 active listings that we have versus the 5,000. So yes, prices have gone up since 2020, but they've certainly cooled off since the heyday of 2021, even 2022. And just been relatively flat in that period since that time.
It's absolutely insane to look at this. We were talking for years and years and years about a housing crisis. If you were to look at these numbers, you would say, what housing crisis? There's so much inventory available. And even when you look at prices are right now, I think it's reasonable. At least price growth, doesn't look so scary that, hey, if we don't buy today, we can't get in tomorrow. And then interest rates are reasonable. They're not, the 2.5% that we had to set the industry on fire, but they're certainly manageable. So then you say, well, if prices are okay, interest rates are manageable, what is holding people back?
You got to wonder. Well, let's dive into that a little bit here. I didn't put my banner up. I made all these nice banners, but so GTA home prices dropped 23%. So why are buyers on pause right now? So with sales down this much, the big question is, where are the buyers? Where are people just waiting for the right time? Are we expecting that they might be frozen by something bigger? Why are buyers hitting the pause button right now? What's your take on this?
This is in this crazy market, in the Toronto market specifically. We hear about people say, "Oh, I'm going to wait for this bubble to burst. Wait for this bubble to burst." I don't even think it's that. I don't think that if you were saying that 7 years ago, and at no point did you ever purchase a property, you're going to be saying that forever. You're just not a buyer. If you're
for sure.
And if housing prices went down to 400,000, you still wouldn't pull the trigger on it, because that's who you are. That's your personality, unfortunately. But there is a real factor. Let me see if I can get this to work. So this is the unemployment rate in Toronto. So looking at Toronto specifically, we looked at it's month over month, 2,000 units less were sold in March than were sold in February. And you say, well, what could stop 2,000 people from making a purchase? And you're like, well, job numbers. If employment doesn't look good and it's not projected to look good, you say, well, I can't buy a house in this market if I'm not certain that I'm going to be employed at the same level as I was previously. Less certainty in employment means less certainty in the market. At the same time, if you were to buy 2 years ago and you weren't certain about your employment, you wouldn't be so worried, because you could turn around in 6 months and sell that property, probably for maybe a little bit of profit that would offset the cost of selling it. So there was a lot of confidence in the market, right? And now that it's a much more flat, steady, slow market, if you lose your job, then you're just stuck with this mortgage and a property that you can't move. So, when we look at unemployment creeping up, or if you want to look at, full-time job growth, you can see after January, it really starts to shrink into March, where it's negative numbers, 7,000, and this is just Toronto, 7,000 full-time jobs gone. So that's really a very influential factor when we look at why properties may not be moving. Where are the buyers? Maybe just waiting for certainty with their employment, because the other factors, like I said, they look okay. Interest rates look okay. House prices look okay. But you need to know that there's certainty for your future with employment.
Yeah, I think, if we take this from a business standpoint, with the tariffs coming in, what the uncertainty of how much are things going to cost to produce, how many people are going to be buying them, businesses are not making these large investments. They're not making capital investments. They're not hiring a lot of people right now. They're holding steady. And so if we transfer that then over to the real estate market, people are making those same sort of decisions. If they are they not going to be moving forward with a purchase because, well, I don't know about my job, or I'm not sure about my company in general. Maybe the company I'm working for isn't in a great place. So it might not be that, hey, I've got a good job, but I'm not willing to make a decision. That being said, if you're in a unionized job, if you're a teacher or a police officer in the government, there has probably not been a better time to buy in the last 4 or 5 years, to be honest.
It's a good point there. If you think that you have security, unless you're worried about the bottom of the market falling out, and I don't think that that's really a concern. It shouldn't be a concern. I think the fact that housing prices have held steady, when you look at specific, unit types, I think that should give you enough confidence to go ahead with it. I certainly would. It wouldn't hold me back. There's nothing about this market that scares me, even in the condo market. I think if you were looking at buying pre-sale condo, there's a lot that scares me about future valuations and pre-sale. But everything existing, you kind of know what you're getting. As long as you can make the payments and you feel comfortable about that, this is
Yeah, I agree.
Yeah,
for sure. So, I mean, a lot of would-be buyers, the hesitation comes down to interest rates. Everyone's watching what the Bank of Canada is going to do. Are rates coming down soon? Should I wait? Should I make a move now? So I want to show you what the Bank of Canada has done so far. And I'm going to just share this screen here. Hopefully we won't have the same problem we had last time. But so in terms of like where the Bank of Canada has been over the last, if you look down here at the trough here, 2020 to 2022, rates were down at a bargain basement rate, and then they went up quite a bit, but we've seen them come down to 2.75% right now.
2.75.
So from 5.25 down to 2.75. We've made a pretty big jump down. So now, will they get back down to 2021 levels? Extremely unlikely. But the bank is projecting, hold on, where's that slide? So the market is expecting another 2 interest rate cuts within the next year. So to go down to 2.25%. But is that a for sure thing? But then you can see right after that, 2 years out from now, and these timelines can ebb and flow like an accordion, they see interest rates going back up, because as tariffs come off, the excitement starts to ramp back up, and there's not the need for discount interest rates. There's the need for interest rates to be higher to try to bring that back under control, because there's all of a sudden excitement and market activity.
I think that with all the industry pause right now, I think that there's going to be a fallout from it. Just the economic activity in general since January, maybe before, being slow, not just the housing market. That's going to have an impact on the future. I could see that it will be a lot less measured. In fact, sort of like maybe we have to look 6 months out, maybe we have to look 8 months out. I'm sort of seeing now a situation where we could see rates drop down to under 1% Bank of Canada in order to recover. I think here's my prediction about what the indication will look like. As long as we can drive around Toronto and we see the sidewalks and the streets filled with these guys on bicycles or ladies on bicycles delivering a bag of McDonald's to somebody's house because somebody was too fucking lazy to go out and get their own bag of McDonald's, as long as we see that, there's no recession. You know, if you can spend an extra to have it personally delivered for you, what kind of economic disaster are we in? Well, once we see those start to taper off a little bit, then we'll start to see those big interest rate cuts to stimulate the economy. That's my predictor, is that less, when you see less Uber Eats.
People will always be, I mean, maybe less Uber Eats, but I think people are lazy in general. Like, people always use Uber Eats or, you know, delivery service. Maybe there'll be less of it going forward. Maybe it'll be the restaurants that are suffering, people eating in more. But I think you'll always have.
But if you can be lazy and afford a personal delivery at the same time, that tells you that the economy may still have a ways to go before we get into one of these dreaded recessions.
I don't see any situation where we go down to 1%, where we go down another 1.75%. We would have to be in the deepest of recessions. The US would have to be in a huge recession. And I just don't see Donald Trump's ego with the tariffs allowing that to happen, where we're in the deepest recession of all time. And that's where I think it would have to go in order for it to be down. I still think, you know, on your Uber Eats thing, I still think there's plenty of people that will be making money and be able to afford Uber Eats.
I don't know.
I wanted to show.
It's just an observation about the market and about the economy that we live in. If people can afford to pay somebody else to drive a bag of lunch over to you, then we're not in dire straits yet. And when we see that start to diminish, that's when we know that big interest rates are coming, because people are going to have to tighten their belt, because clearly they haven't yet.
Well, let me show you this one. So this is a comparison between the price of properties, which is the red dots, and the Bank of Canada interest rate cut. So the biggest the biggest increase came in July 2022, and we've been relatively flat in GTA average prices since that time, despite the Bank of Canada interest rates going way up, and then also coming way back, you know, about halfway back down to 2.75%. So I don't see that, you know, this seems to be where prices have bottomed out. Is there an opportunity for them to be lower in certain circumstances in condos, for example, in the 905? Absolutely. There's probably still some room for that. But do I expect like detached properties to drop in half based on that? I don't see that. I also don't see us going back up to those January, February 2022 numbers anytime soon either.
No, there's nothing on the horizon that looks like it'll take off like it did before. Even with interest rates, I think that there's, I mean, other than, you know, potentially immigration, we don't really know 100% what's going on there. But when the government starts pumping the brakes on stuff, even if it's, you know, we learned this, even with Trump, if he even talks about pumping the brakes, the market reacts. And right now we've got such a market slowdown. That's why I'm seeing, you know, perhaps we can get to those low interest rates again. But it means that we haven't ground to a halt, but it's certainly very, very timid. It's a very cautious market right now. But the longer that drags on, you know, the more drastic the recovery is going to likely have to be on the other side of it. Or at least that's how I'm interpreting it, that, you know, if we don't come out of this quick enough, the lag, all the industries will fall behind, spending will drop off, and then we'll need to do something drastic to get it stimulated again.
Well, and you know, predictions I've seen, and I'm not an expert on this by any means, but if the tariffs are on for a few more weeks, the market has kind of priced that in when it comes to interest rates and what might happen next. If the tariffs go on for months, that's where we will see deeper rate cuts and rates falling. But the bank, the market is predicting another 2 interest rate cuts, and they've priced in these tariffs already. So, but if this goes on another 6 months, we're in a lot of trouble. We're starting to see the economy really start to grind to a halt in that scenario.
Right, really pulling back. I mean, we've seen it with the employment numbers, at least for a month. I mean, like these numbers do, we interpret it after the fact, so none of this is like live in the moment. But if the trend continues, then we can start making better, predictions on it.
Yeah. So now here's where it gets a little confusing. Even though the Bank of Canada is cutting rates, we've been seeing fixed rates and variable discounts quietly heading in the opposite direction. What is going on? Why would fixed rates be going up and the discounts on variables be getting worse when it's really pointing in the direction that we should have lower interest rates right now?
It is crazy. I mean, I don't think it's a great time to jump on a variable rate mortgage, expecting that the Bank of Canada is going to carry the burden of reducing your payment and reducing your interest rate. And when the predictions are like, yeah, we may have 25 basis points, 50 basis points cut by the end of the year, or maybe now over the next 12 months, the projections are timid for Bank of Canada rate cuts. So in that case, you would need your variable rate discount to carry the burden of that, and it's just not there.
No, I agree. And with the banks have quietly been reducing those discounts on variable rates as the Bank of Canada rates have come down. The variable rate has come down. The discount has been getting worse. So now, if you're going to take a variable rate, you're no longer in the position that we were like a year ago, where it's like, well, variable rates have nowhere left to go but down. Variable rates are a good decision versus locking into a fixed rate for 5 years at like 6% or 5.5%. We were there was nowhere else for them to go but down. Now there is some room for variable rates to come down a little bit. As we said, another 50 basis points is what the market has priced in. I know there's a potential for them to be lower. But that is on the outside of the predictions, not the mainstream of. It's certainly possible, but not mainstream. So if you're going to take a variable rate, you're taking a rate that is higher today than what a fixed rate would be, and you're kind of banking on a huge recession to bring.
I think you're asking too much for the Bank of Canada to help you out in that regard, and there's just the evidence is just not there. I mean, long term, hey. If the economy tanks, yeah, you're going to get your interest rate, but is that really what we want to be cheering on? We really want to be cheering on job losses and because it's a bad deal for Canada. So I read the article that they sent, and Ron Butler suggested that if the banks can push you towards a fixed rate, they would much prefer to do so. They can charge more in penalties if you break the mortgage. They can make more money off it. So that's that's like sort of a factor that I didn't consider. Is like, oh, why are the discounts shrinking? Because that's troublesome. Yeah. And if it's just simply because it's better for the banks to put you into a fixed rate mortgage, well, why not?
Well, profit, right? Yeah, the profits are better on the fixed rates. The penalties, as you mentioned. So everything comes with a caveat. If you're expecting that you're going to have some sort of major housing change or transformation in the next 2-3 years, then the fixed rates are probably going to cost you more, even if you're starting at a lower interest rate than you would with the variables. And also the variable, because of those penalties, and also the variables, it's more of a lifestyle and how do you view money? How do you view that risk? If you're going to be watching the Bank of Canada press releases 8 times a year and you're going to be worried about where your payments are going to be, then a fixed rate is just a better sleep at night scenario for you.
That's good advice.
Because nobody rings a bell and says, oh, now's the time to lock into a fixed rate and you're going to save yourself a couple of bucks by going variable and then switching to fixed at the last minute. That's not really a good use of your time.
No, I don't think it usually works out that way either. Because when fixed rates come down, it just seems like the variable rates are just underneath it. But this is, I
Yeah.
guess, it's unprecedented to see right now that your starting point with a variable would be higher. I don't know if we have a slide from that, but you can pull it up on, is it maybe Rate Hub or something like that. You can see the trend, and the variable has always sat like 2% underneath wherever the fixed was. So it was always a really good bet, not just against the penalties, but financially in the moment, the variable was always less. This is a really strange time where that's been flipped upside down.
It is a strange time. I mean, for a number of different reasons, right? But the variables, usually when you're going to lock into a variable rate and you're thinking, okay, rates are at the bottom, the fixed rates are already gone back up and they're already projecting where things are going to be. So if you're thinking, I'm going to wait for variables to fall and then lock into a fixed rate, that fixed rate is almost always higher than what your variable would be. So then you're expecting, okay, the interest rates are going to go way back up. You're just making a lot of bets between going that short-term strategy with variable rates. There's a lot of ways to lose money in that scenario.
Yeah, I mean, if you're variable, I think you're right about the lifestyle. So you're just going to let the market decide, and you're going to ride it out with the market, and markets go up, markets go down. So
yeah,
if you're comfortable with that, that's the way to go. Right now, over just the last couple months, the variable discounts have just been quietly shrinking. So they're making it less attractive for people to jump in. When we look at all these different factors that are like, where are the buyers? So like, well, they're getting, death by 100 cuts or 1,000 cuts or whatever. This is what's happening. It's like everywhere you turn, there's another reason for a bit of uncertainty. So it tells you that people aren't stupid. If
you're making a short-term decision, you're looking to flip real estate in 2-3 years. Yeah, probably now is not the time to buy. But if you're making long-term housing decisions, prices are way down compared to where they were before, depending on what you're looking at. And the cost to borrow money is down.
Yep.
It seems like a perfect scenario to me, especially if you've got certainty in your employment.
If you have certainty for employment and you can stomach the idea that you're not going to get a discount on the rate like you would have 2 years ago, and that could freeze some people. I don't think it should freeze somebody. I don't think that's a smart decision, saying, oh, well, the market was cheaper 2 years ago or the rates were better 2 years ago. Like, I don't know what you can hope to expect from your future if you're only looking in the rearview mirror. But if you're forward thinking and you think that you have that security, you're not in a bad spot right now at all.
No, and I agree with that. I think one thing I also wanted to mention, I don't know if you saw our good, not our good friend, we don't know him necessarily, but brings us to somebody who is never shy about telling it how it is, and that's Ron Butler. He was on the BNN show The Open the other day, and he had some things to say about what's happening with the condo market. So let me just tee this up here, and
I would say in Ron we trust. If you're in the industry, you should definitely invest 6 minutes of your time to check out Ron's opinion.
Yeah. All right. Let's play it here.
I'm not getting the audio on this one, buddy.
Interesting. I wonder why. All right. Well, let's put the link. Let's summarize what he said here then.
Yeah. I mean, really specifically, I think that the clip that you're referring to is talking about future condo prices. So if you're thinking about buying a condo pre-construction right now, saying the future valuations are way off. There's nothing out there in the market right now that supports their predicted future values. And then when he's talking about units that are sitting on the market, he's like, those were essentially purpose-built rentals for investors, under 500 square feet. What do they say? Basically a size of a hotel room. And those are the units that aren't moving.
Well, that
Sort
was
of
the rage,
understandably,
right?
I would buy one. Like if I felt like I could live in one, like if I had the lifestyle, I would. Again, I wouldn't hesitate. There's nothing in this market that scares me at the moment, other than if you were worried about employment.
Well, and I think there's a lot of people that are like you. I just don't think that there's enough of people like you based on the number of the amount of supply of these tiny little condos. Ron calls them, not in this clip, but he calls them dog crate condos. Like they're just so tiny. It's not purposely built for families. And so even though we are in this housing shortage, we have an oversupply of one specific type of condo supply, and that's the 1-bedroom micro condos, things under 500 square feet. There's not a lot in the 800 to 1,000 square feet condos, something that could be used for families, which is what people want. So we're seeing, especially in the 905, the surrounding areas, those property prices have gone down quite a bit. I just anecdotally, this is not a market trend, but I was looking at what things were selling for in 2022 when these new condos were being listed. So maybe like 750,000 for a 2-bedroom condo. I saw a listing in that same building. It's listed for $499. So
for a 2-bedroom.
For a 2-bedroom near the GO train.
905. Wow. I think that there's a ton of value there, because if we're talking about the 400 square foot bachelor condo, I understand that you're going to, even if you buy it today, you're going to grow out of it in a few years. If you're, planning on growing a family, or if your career advances and you're going to say, you know what, another 100 or 200 square feet would make a big difference in your life, and it would.
Yeah. Wraparound balcony, parking, all the amenities.
Right. So I could see I could see a hesitancy to get in to a unit like that today, because what's the indicator that you're going to be able to sell it for even a small profit in 3-4 years once your career is advanced or family situation has grown. So I could see that, but for a 2-bedroom to drop in that price, 2-bedroom you could raise a family in, theoretically.
Yeah, no, and but the one of the other problems I noticed was that the property taxes are based on a higher valuation as well. So you're not getting the $2,200 in property taxes like you would for a $500,000 condo in Toronto. You're getting $6,000 per year for property taxes, which is
that's prohibitive. Okay, well, for sure.
That's a lot. I've never seen property taxes being reevaluated downwards, but maybe that does happen. But it seems like a lot of other costs that go involved with it. But then maybe you don't have to shovel snow. Maybe you've got other things that you're not quite worried about with that, and that's worth that price to you.
But you would assume, I would assume anyway, that the value of that condo, the 2-bedroom condo, eventually gets back and above to where it was before, gets over the 700. So depending on condo fees or property tax, there's definitely going to be value there. I'm shocked to hear that that big of a difference.
I'm sure this is a one-off and it's a marketing strategy, and they have no intention to sell it for 500,000. But they're not getting 750 for it for listing at 499. Do you know what I mean?
Yeah, for sure. They're not. And I think that the bidding war strategy in general right now is probably tired and people
That being said,
aren't in a rush.
I had a client last night lose out on it was a 2-bedroom detached house in East York on a busy street, and they lost out. There was 9 bidders on the property. So depending on the type of stock, there are bidding wars still. Are, hey, let's list it for $899 and let's see what people show up with. and probably ends up going for somewhere over $1 million or $1.1 million. You know what I mean? Like, it really depends on the strategy and who's interested.
Yeah, well, look, nothing really surprises me in this market. But we all have always known that desirable properties can sell above asking. I guess
Yeah.
it
Yeah,
just depends where
absolutely.
you put asking.
For sure. All right. Well, I hope that was a helpful podcast. And if you liked it, please like and subscribe. Tell all your friends about it. And if we will hopefully see you next week. Thanks a lot, Vaughn, and we'll see you later.
Take care.